Thanks very much, Adam. I'm just going to kick off with a karakia, just to welcome everybody into the room and set the scene for today's discussion. So, mai e te tupua, mai e te tahito, mai e te kahui o ngā riki, mai e te whiwhi atu kia tū, mai e te whiwhi atu kia rongo, mai e te whiwhi atu kia tānei, haume e, hui e, taiki e. I might just explain that one for those of you that are not from New Zealand. What it's essentially saying is behold the wisdom, behold the law, behold the collective knowledge that abounds here in the room. Be courageous, be empathetic, be resilient, bring us all together with a united purpose. So let's proceed. So it is my great pleasure to welcome you all back here to the second day of the Reserve Bank of New Zealand's Research Conference. And what an occasion it has been so far. Over the course of a single day, we've heard presentations from leading academics and institutions from across the world, diving deep into current thinking and developments in monetary policy. In the morning, obviously, we started with the big picture in a wonderful opening address by Dr. Ben Bernanke. We were lucky to have such a clear overview of the history and design of inflation targeting by someone with Dr. Bernanke's depth of understanding of and experience of inflation targeting. We heard both his support for the role that inflation targeting has taken on internationally, as well as his challenge to improve central bank communication and engage in messaging involving alternative scenarios. And as we all consider how to approach future economic challenges, particularly those related to supply-side shocks, this advice will obviously be at the forefront of all of our minds. Throughout the day, we then built on those observations, and it was insightful to see what makes inflation targeting successful, not just in advanced economies, but also emerging. It's a reminder of the importance of the broader context when we're thinking about inflation targeting, so central bank independence, institutional arrangements, and the health of the financial system more broadly are among others. Reviews of monetary policy performance and frameworks have also been a major focus in central banking circles, particularly in the light of the recent bout of high inflation. We heard about the evolving role of these reviews, the need for external evaluations, and the importance of transparency and accountability in central bank decision making. I personally found it very useful to get a bird's eye view of the various approaches that are being adopted globally and how these reviews are evolving, and it provides a strong base to consider further what best practice might look like in the future. A key issue identified in our own, I say recent and it's not so recent anymore, 5-year review of our monetary policy performance was a need to better understand the supply side of the economy and how we should respond to supply shocks. In the post-lunch presentations, we learnt that moderate central bank response to supply-driven inflation may provide better welfare outcomes, and also a discussion on the significant influence that global forces can have on domestic neutral interest rates. The afternoon also provided a fascinating opportunity to see how central banks and researchers continue to evolve their use of data, survey evidence and empirical analysis to tackle key questions in monetary policy. At the Reserve Bank, survey and microdata analysis is central to refining our economic models and forecasting systems, so we greatly appreciate hearing from experts in this space. These discussions not only enhance our own understanding, but also provide insight to improve the tools we use to navigate in what is an increasingly complex economic landscape. Today, we're going to look forward to a theoretical discussion this morning on optimal policy for managing large shocks and conditions when monetary and fiscal policy should work together or in opposing directions. After lunch, we will hear from our very own researchers here at the Reserve Bank. Members of our research team will focus on the drivers of New Zealand's natural interest rate, assess monetary and fiscal policy interactions using frontier econometric methods, and also evaluate the effects of quantitative easing in New Zealand during the COVID-19 pandemic. Policy making during the pandemic will also feature prominently in the final panel session this afternoon, which will delve into how monetary policy should be conducted in a world with increasing supply shocks. But of course, before all that, it gives me great pleasure to introduce our second keynote speaker for this conference, Dr. Catherine Mann. Over her extensive career in academia, government and the private sector, Dr. Mann has published dozens of journal articles and co-authored a number of books. Her main contribution has been in the field of international economics. Dr. Mann has a bachelor's degree from Harvard and a PhD from MIT, seems to be very popular. She has enjoyed a distinguished career at a range of international and economic institutions, including the World Bank, the Federal Reserve, the President's Council of Economic Advisors, and the Peterson Institute for International Economics. In 2014, she joined the OECD, serving as the Chief Economist and Head of Economics Department. And between 2018 and 2021, Dr. Mann was Global Chief Economist at Citi. Over her career, she's also served on numerous boards and governing bodies, including the Executive Board of the Committee on the Status of Women in the Economics Profession and the Board of the National Association for Business Economics. From 2021, she has been an external member of the Bank of England's Monetary Policy Committee. During her tenure with the Bank of England, she has been vocal about the risks of persistent inflation and advocated for proactive policy responses. She has emphasised the importance of evidence-based decision-making in her speeches, discussing monetary policy during recent inflationary shocks through the structure of a balance of uncertainties. In outlining her views, Dr. Mann regularly references the latest developments in data, including consumer price microdata and inflation expectation metrics. Evidence-based decision-making is also a cornerstone of the Reserve Bank of New Zealand's monetary policy frameworks, and so we are absolutely delighted to have you here today at our conference here today. And please join me in welcoming Dr. Mann to the stage.
Well, thank you very much for this kind introduction. Of course, I'm delighted to be here. My longtime colleague, Paul Conway, reminded me that this is my fourth time to New Zealand. I'm not counting up the number of hours I've been on an airplane. But the first time I was here was about 25 years ago on a short secondment to the RBNZ. From when I was on the Federal Reserve Board. So there's sort of a bookend on my career path, starting at the Federal Reserve Board in Washington. I'm not saying I'm ending my career at the Bank of England, but for where I am now, I've been a central banker and have traveled elsewhere during the course of between those two bookends. Now, of course, it's particularly fitting to discuss the value of the inflation anchor at the Reserve Bank of New Zealand, the first official inflation targeter. In the 1980s, and with the objective of accountability and transparency and productivity growth, the 0 to 2% target emerged as New Zealand's government's chosen measure. Other central banks or governments followed suit, with the UK adopting inflation targeting in 1992. Today, I'm going to focus my remarks on what we need to anchor, how to measure whether the anchor is holding, and what a central bank needs to do as domestic economies face more turbulent waters. It was pretty turbulent out there when I arrived on Saturday afternoon. And on Sunday, with the dragon boat racing, there was a bit of a turbulent episode when one of them turned over. Everybody was fine, but I think there was a little bit of an embarrassment. I think the sweep fell off the end, and that was the end of that. Now, as I discussed last year in my speech on the end of the Great Moderation, achieving low and stable inflation over much of the last 2 decades was attributed both to good policy, meaning inflation targeting, but also arguably good luck, fewer shocks. Now, the latter, I'd say, good luck, probably has run out. So the dependence on the former, inflation targeting, is that much greater. So critically, inflation targeting has provided a framework for extensive research and empirical analysis of both data and shocks so as to develop a deeper understanding of how the tools and transmission of monetary policy act to achieve the target. So it's not just about the target, it's about the process. So central to this framework is the anchoring of long-run inflation expectations to the inflation target. If a central bank has this measure of credibility, monetary policymakers can pursue the policies needed to achieve low and stable inflation in the face of shocks, trade-offs, and lags. However, microeconomic behaviors, such as how prices and wages are set, and behavioral thresholds of attention to inflation will influence the transmission of shocks and the ability of monetary policy to anchor long-term inflation expectations. Now, in addition, a key factor for the UK, a small open economy with a global financial center, is cross-border spillovers. We, meaning in the UK, and I would arguably you too, small ships in big oceans. Bigger ships, we can say where they're from, can create large waves, real and especially financial, which in my case, the Monetary Policy Committee needs to assess and to evaluate the policy strategy that will best hold the anchor in the face of those cross-border spillovers, among the other factors. So I'm going to focus my remarks today on the choppy seas of the past 2 years and what we can learn to apply to the likely continued turbulent waters that lie ahead for the UK economy, which may test the credibility of policy to hold firm the inflation anchor. So here we go with this. There we go. All right. So the whole concept of inflation expectations and anchoring of them is elusive, but it's central. So by definition, the nominal anchor is the 2% target. Achieving 2% is the successful outcome, but it is not the process. The MPC's latest minutes defines this process, the collective MPC language in the Monetary Policy Report. The Monetary Policy Committee sets monetary policy to achieve the 2% inflation target in a way that helps to sustain growth and employment. The MPC adopts a medium-term and forward-looking approach to determine the monetary stance required to achieve the inflation target sustainably. So there are a lot of little pieces in that, and some of them, in fact, are reference to the central bank review and the overall portfolio in the central bank review that Renee talked about yesterday. So if inflation expectations is key to both the process and to achieving the target, how should we measure it? How are expectations formed? How does that interact with shocks, spillovers, behaviors, and policies? To keep 2%, keep the inflation at 2% sustainably means that's where inflation expectations should be too. But what about this notion of at all times, which is language in our remits, that the inflation should be 2% at all times? Short-term expectations should and are expected to deviate from the target from time to time. So those aren't presumably what we're trying to target. On the other hand, long-run inflation expectations should be anchored, and they should be insensitive to near-term macroeconomic developments. But this difference and anchoring to the long term is conditional on the Bank of England's credibility, which has been built through actions taken by the MPC historically to return inflation sustainably to target. So we have to constantly reassess the underpinnings of long-term inflation expectations and to take actions to reinforce the anchor. So I'm going to go through now a set of measures to help me assess the underpinnings and anchoring of expectations. So the first one to assess the anchor is to look at the level and distribution of inflation expectations, short term, and these are the medium term. The level of inflation expectations in absolute or relative to some historical average can be used to measure anchoring. Simple rule of thumb says, how much do expectation measures deviate from 2%? But that's not my preferred measure because sometimes and some measures have never averaged 2% in the past. These are reasons other than lack of anchoring. We could talk about RPI, for example. On the other hand, the distribution of inflation expectations is a rich source of information to determine whether expectations are anchored and how they may evolve in the face of incoming data. So the chart that I'm presenting here compares the distribution of responses in the latest Bank of England Ipsos Inflation Attitude Survey. The latest distribution is in aqua, against the pre-pandemic average from the same survey, which is in orange. And you can see the responses and the buckets that they are in along the horizontal axis. The most striking aspect is the perceived certainty in the latest quarter of responses relative to the average. And you can see that by the change between orange and the current aqua in the don't know column, which is on the far right-hand side. So what this tells me is that there's higher attentiveness of households to the current inflation environment. The second point, however, relates to the body or bulk of responses in the larger than 5 bucket. In fact, a larger share of respondents expect inflation to be higher than 5% in 5 years' time, rather than anchored at 2%. Now, I can also look at these distributions over the entire survey sample period. I'm not showing that here, but I can show you that. And it shows a rising gap between the mean and the median, indicating that the bucket of right tail responses of higher than 2% inflation expectations at the 5-year mark is increasing over time. This drift in household expectations concerns me a lot. Now, it's well documented in the literature that the formation of households' inflation expectations involves high weights on salient and volatile consumer basket items such as food and energy. We have quite a bit of research that looks into this topic. And when these prices rise, as has been the case over the past few years, so do inflation expectations. And they tend to be sticky coming down relative to their immediate reaction going up. On the other hand, when inflation is low and stable, households may be rationally inattentive. Now, the information from the tails of the distribution matter because, as researchers say, decisions depend on the subjective perception of the state of the world, not the objective state of the world. Perceptions are very important. So I keep track of the tails because they reflect the balance of how households are going to look at the inflation potentially rising from the food and energy prices relative to the potential for slowing consumption associated with rising unemployment, about which I'll talk a bit more, and the pricing power and moderation of pricing power of firms. So let's look at another measure of medium-term inflation expectations, and that's of financial markets. So the Bank of England's Market Participants Survey, MAPS, offers a window on how distribution of long-term inflation expectation has changed over time. This chart shows that there has, again, there's buckets and different time periods and responses by financial market participants of their medium-term inflation expectations. Now, what this shows is that there has been a shift to the right in the long-term expectations for inflation, the taller purple bars on the right of the chart, and there is a notable skew, positive skew, in the distribution. Nearly half, 48%, of the probability mass lies above 2.2%. So while not as dramatic as for the households, this drift in financial market expectations for medium-term inflation expectations also concerns me. Now, I'm going to move to a second measure of whether long-term inflation expectations are anchored. When long-term expectations are anchored, we would typically expect them to be insensitive to near-term macroeconomic shocks. This is because the monetary policymaker reacts such that in the long term, the effect of the shocks wash out and inflation returns to target. As this is a measure of our credibility, we want to test whether it holds in the data. So we're going to look at for first households and then briefly for financial markets at a macroeconomic shock that we would expect to affect short-term inflation expectations, but hope, under credibility, to leave long-term inflation expectations anchored at target. So what I'm showing you here for households is the impulse response function of short-term inflation expectations in aqua and long-term inflation expectations in orange to a global oil supply shock. And there's a variety of technical things we could talk about exactly what shocks to use and so forth and so on. But taking that as given, consistent with the salience literature that I've mentioned before, short-term expectations are considerably more reactive than long-term expectations. The aqua goes up and then comes back, and the orange is fairly flat. On the other hand, long-term expectations do react at least somewhat for about 5 to 6 months following the shock. Now, for financial markets, which looks pretty similar, not identical, but pretty similar, the duration above target in the orange line is a bit shorter, and the stabilization of long-term expectations looks pretty good. Putting these two together, though, the evidence suggests, and this is all based on historical UK data, the evidence suggests that the UK policymaker, through this model lens, as estimated from the historical data, has underreacted to global oil supply shocks, perhaps as they thought they were transitory, maybe they wanted to look through the temporary shock, or maybe there were some other things that were relevant in their policy reaction function. Nevertheless, the underreaction did allow long-term inflation expectations to temporarily drift away from the anchor. And that will be an important consideration as we think about the more recent set of shocks, and also potentially the greater set of shocks that at least I expect to see in the global environment going forward. In the end, however, over this historical sample, the MPC's commitment to 2% along with fortuitous globalization luck, which happened over history, sluggish domestic demand after the GFC, also which happened in the history, both of those things, along with the commitment, prevented the drift identified in the IRFs from becoming embedded. So we had both good policy and good luck. Now, monetary policy affects long-term inflation expectations through the systematic and predictable way in which it responds to offset pressures that would take inflation away from target. This predictable expectation, which is also called the reaction function, forms the credibility of monetary policy makers, so long as it is reinforced in times when shocks hit. Having established this credibility and this reaction function, should the monetary policymaker respond to future shocks in exactly the same way as they have in the past? I would argue it depends on the extent to which the shocks, microeconomic behaviors, and financial market spillovers are also like the past. If the nature of the shocks or the state of the economy are sufficiently different, the reaction function needed to hold the anchor may also need to evolve. Therefore, clear communication around inputs to the reaction function is essential. The value of the anchor lies not just in the target, but in the process that when the monetary policymaker reacts to a shock, their policy will work as intended. So let's look at a third measure of whether or not the anchor is holding, and that is an assessment of expectations formation that is endogenous to the macroeconomic environment, including monetary policy. We saw a different measure yesterday, a different approach to measuring endogenous expectation formation in the research paper presented yesterday afternoon. Now, what I'm going to show you here is an empirical method from a set of colleagues that we've been working with for a couple of years now, which highlights that expectation formation is endogenous to the macroeconomic environment, including monetary policy. Now, this method uses historical data. As you can see, it's a very long time series, going back to the 60s, to calculate the time varying and shock-dependent share of backward versus forward-looking agents in the formation of overall inflation expectations. The share of forward versus backward-looking agents matters since after a period of elevated inflation, and in the context of a bumpy disinflation process, the anchor can drift away from the target consistent 2%. I sort of showed you an IRF where that happens. Now, if agents become more backward-looking in their expectations on account of this drift, that can be a problem. Now, I presented a theoretical model in a speech last year, which shows that the more agents look backward in their formation of expectations, the more persistent is inflation in the face of shocks, and the greater the need for monetary policy restrictiveness, along with a worse inflation trade-off. So bad news across the board, so you don't want to let this happen. So what this chart shows is an estimation of this time-varying share of fundamentalists, which is the vocabulary word that the researchers use, translates into forward-looking agents in the UK economy. Now, this is, again, UK data. In this methodology, the agents can choose between two different forecasting rules. And they can choose a different rule each time period. Now, one rule considers information about the wider macroeconomy, including monetary policy. These are the fundamentalists. The other is a naive rule, which just takes last period's inflation rate as the prediction for next periods. These are the backward-looking ones. Now, the rule, that is the methodology, and the important aspect of this rule is it relies on learning, costly learning, in the face of information. So given the cognitive and also real menu costs associated with having to be attentive to inflation developments and responsive to them, Sometimes economic agents are better off just looking back at recent outturns instead of trying to forecast what inflation might be. So in the chart up is a higher share of forward-looking agents. And those, when it's high, the forward-looking agents conclude that the cognitive and real costs of forecasting, including forecasting central bank reaction functions, is worth it. Backward-looking agents are just going to look at the previous period. Now, the chart shows that the balance between forward and backward-looking agents in the UK economy varies significantly over time, over shocks, and over policy. For example, in 1992, the introduction of inflation targeting was associated with a rise overall in the share, if we kind of look at that center period, inflation targeting. It's not always high, but it is higher than it rose and then has stayed higher, up and down. The introduction of inflation targeting was associated with a rise in the share of forward-looking agent. The institutional design and associated communications appear to have given agents the belief that the central bank would pursue policies to maintain low inflation. So this makes central bank credibility part of the macroeconomic fundamentals that agents consider when deciding how best to inform expectations. It also appears from this chart that significant macroeconomic events mark turning points in the series. Expectations became more backward-looking following the oil shocks of the 70s, the global financial crisis, which also coincided with an oil price shock, and Russia's invasion of Ukraine. Again, an energy price shock, all in the UK. Now, to take what is a sort of a bouncy-looking chart and make it a little bit more econometric, this chart shows the estimated local projections of the share of forward-looking agents onto a global oil surprise for the same time period as the previous chart. So I'm using the same data, local projections, how the share of forward-looking agents change in the face of global oil supply surprises. So what came out of the previous chart, by kind of looking at the lines and so forth, expectations formation becomes more backward-looking after such surprises. An oil shock that increases oil prices by 10% appears to be followed by a 2 to 3 percentage point decrease in the share of forward-looking agents in the year after the shock. And they stay forward-looking for a number of quarters after the shock. So backward-lookingness becomes more prevalent, and to the extent that that is continuous over time, that backward-lookingness yields more persistence in the inflation process, which generates the need for more monetary policy restrictiveness. So the bottom line of this exercise, first, expectation formation moves systematically, co-moves systematically with shocks. Both expectations formation and the effectiveness of monetary policy are endogenous to the state of the economy. So in the face of large shocks and more volatility, monetary policy needs to act more strongly than the historical reaction function might suggest to maintain the anchor and prevent higher inflation expectations from becoming embedded. So that's all about expectations formation. But there's another aspect to the target that I think we need to address, and that is, where did the 2% come from? And why should we think 2% is a good number versus, I don't know, some other number, like 3% or maybe 4%? So, 4%, 3% and 4%, not so long ago, were bandied about in the literature by some, well-regarded colleagues of ours in the research community in the post-GFC period. So it's not long ago that somebody was saying 3% is just fine, maybe 4% just fine. So maybe not. The question is, why not 3%? So high inflation has costs in a broad sense, not just in monetary policy terms, not just in monetary terms. And of course, it's very unpopular with households. Higher inflation is associated with more attentiveness, which means that more resources are devoted to evaluating current inflation and forecasting it, rather than spending resources on real-side decisions such as investment, savings, and consumption. High inflation and high inflation volatility go hand in hand. You can see a great chart of that in my Great Moderation, end of the Great Moderation speech. So high inflation and high volatility go hand in hand, and this blurs the relative price signals, which distorts sectoral allocation, and within product markets provides an umbrella under which firms can raise their own prices when competitors raise theirs. Again, work shows this asymmetry in high inflation environments. In addition, there's research that suggests the cost of inflation rises non-linearly with the inflation rate, and that there are important thresholds for when households and firms react to higher inflation. For example, supply shocks are 2 to 3 times more inflationary in a high attention environment once the inflation threshold is surpassed. Now, there's research that is referenced in the longer speech that shows that 4% appears to be an important threshold for attentiveness. And given that in the latest UK projections in the Monetary Policy Report in February, inflation is projected to rise to some 3.7% in the near term. So we have to be especially alert to these dynamics. So what does any of that sort of discussion have to do with the specifics of a 2 to 3 or 3% target for the UK? So what I'm showing in this chart is a histogram of realized inflation rates in the UK since 1998 alongside 2 density estimators, a kernel density and a standard normal. Clearly the normal in aqua does not represent the data well. The kernel density, which does represent the data more closely, shows that on the good side, distribution of inflation outcomes are peaked at 2, which is between 1 and 2, which is good. That suggests that our anchor is holding. On the other hand, it has a very fat right tail, so something we need to worry about. Suppose the inflation target were 3% and not 2%, and agents responded accordingly. What that would do is shift the distributions. A simple version would just shift the distribution to the right, and doing so would increase the occasions of being above 4% from about 13% of the time to 25% of the time. So if we just shifted our target to 3%, and everybody said, yep, 3%, that's going to be my target, and we took exactly the same type of distribution, then we would actually have realizations of inflation above 4%, 25% of the time. And again, that's probably an underestimate of the number of times probability we would be above 4%, given that the shape of the distribution would likely to have an even larger right tail. All right, so let's talk a little bit more about turbulence. In a small open economy, the UK policymaker is not the only ship in the sea, and it can be racked by waves coming from elsewhere. And I'd like to talk about one particular type of volatility and turbulence, and that is financial market turbulence. There are a number of different ways we can talk about financial market turbulence, and I've used a couple of different methods over the past couple of speeches, but I want to focus on volatility in asset markets today. So I'm showing you here estimated shock volatilities from a set of stochastic volatility models. Now, the shocks are by construction uncorrelated. The shocks are uncorrelated, but their volatilities clearly co-move. So financial market volatility increased 2021 and 2022. You can see that with the spike going up. The longer time series is in the left-hand side, and we kind of blow it up a little bit more on the right-hand side to give you a closer look at the more recent data. There's one notable outlier that has not sort of normalized, and that is the U.S. monetary policy factor, which is in light green. That suggests that U.S. monetary policy has an outsized effect on UK interest rates. So what does this mean for monetary policy? In these choppy seas of past and current shocks, my inflation targeting framework emphasizes evaluating how disaggregated data, microeconomic behaviors, and cross-border spillovers affect inflation and expectations. I've already noted that we have a key shock that's already in train, having to do with food prices and energy prices rising in the UK, accounting for about 0.7% on projection, about 0.7% of the 3.7% that is projected for inflation in the middle of this year. So given this projected inflation hump, this salience of energy and food inflation, the right tail risks in the distribution of households' expectations, the need to remain restrictive is particularly important. So restrictiveness is important for all of those reasons. Okay? On the other hand, you probably know that I voted to cut by 50 basis points at the February meeting. So you might legitimately ask, why? I need to look 6 to 9 months ahead for sources of inflationary pressures. I showed in detail quite a bit of the conjunctural information that was relevant for my decision to vote for a 50 basis point cut. It basically looks at prospects for a nonlinear adjustment in labor demand as firms have to manage and adjust in the face of 3 years accumulated increase in labor costs. And we have decision maker panel evidence on that likely nonlinear adjustment to labor demand. There are already high savings rates, which has limited consumer demand to be quite weak. Those will probably be augmented. There's a buffer against volatile purchasing power. There's a buffer against, savings buffer against mortgage refinancing costs. And in the face of additional labor unemployment, we would expect an increase in the savings buffer associated with unemployment risk. So that collection of downside risks, in my judgment, over the next 6 to 9 months, that the wage and price setters are more likely to have to absorb the inflation hump rather than pass it through. So is there any evidence that I can point to that my judgment 6 to 9 months ahead is going to turn out to be true? So agents' assessment of 1 year ahead wage developments. Now, this is price developments, but I can also look at the wage prospects, 1 year ahead wage settlement prospects from our decision maker panel, and I can show that those assessments are very near to being target consistent. But inflation ultimately comes from the pricing power of firms. So this shows evidence for the DMP sample 1 year ahead pricing power over time that firms think that they will have. And over time, you can see there has been a shift to the left, which is good in the mean. But the more important aspect of this chart in the most recent data in Aqua is their uncertainty. The distribution is wider, meaning they have less certainty about whether or not they're going to be able to get the prices that they thought they were going to get. So that can explain why I would cut, but it doesn't explain why I voted to cut for it by 50 basis points. So I'm going to come back to the financial markets. And of course, you know that the MPC collectively judged that a, quote, gradual and careful approach to the further withdrawal of monetary policy restraint was appropriate. So the collective judgment of the MPC, majority judgment, was a 25 basis point cut in bank rate. So the gradualism as the preferred monetary policy strategy was promulgated at a time when financial flows were small and markets stable. Gradual moves in the, you can remember Brainerd and Woodford, gradual moves in the policy rate were seen to prevent monetary policy from creating excess volatility in financial markets, which would hamper transmission. But I just showed you a previous chart with a stochastic volatilities that these days, the volatility is coming from financial markets, especially cross-border spillovers. And here's some additional evidence on that volatility. Despite the MPC having twice cut bank rate by 25 basis points in August and November of last year, the short end of the curve has been quite volatile, with little of the loosening passed through. The overall trajectory of short-term interest rates has been up. The short end of the yield curve has flattened as the 1-year, 2-year, and 3-year ahead rates have all coalesced to close to 4. In short, the international spillovers have dominated the signals from UK domestic data and monetary policy actions. With substantial volatility coming from financial markets, the founding premise for a gradualist approach to monetary policy is no longer valid. Hence, 50 basis points to cut through the turbulence. To conclude, unlike the Taiharo, New Zealand's entry in the Louis Vuitton America's Cup, where you won it, the way the entries look these days, it's not a yacht anymore, it's kind of like a spaceship. It skimmed above the seas off Barcelona to win the cup. Now, monetary policy, on the other hand, has to navigate through the choppy financial markets, the shock-ridden economies, and these sticky and drifting expectations. So larger cuts, as the one I voted for at the meeting, cuts through this turbulence to more effectively communicate the stance of policy and to influence the economy. At the same time, keeping monetary policy restrictive for longer allows me to evaluate developments on inflation persistence and how well the anchor is holding. So the combination of larger moves and, depending on developments, longer holds is what I have called my activist monetary policy strategy. Thank you.
Five minutes for questions. So, you happy if we do 2 to 3 at a time?
Yeah.
Yep. Okay. All right. They're all putting up. Okay, we'll start over here with you, Paul, and then Ranko and this gentleman over here.
So thanks a lot. I really enjoyed your speech and the details that in it, a lot of it. So I've got a couple of remarks. So the first remark is, in the inflation expectations move, the move to more people being in the higher buckets, the +5 bucket, I know in the Australian survey, my background, you end up with this sort of effect where respondents end up saying 5, 10 or 15. They end up jumping into particular buckets. And I know the paper yesterday did what you might do is sort of stratify, strip out that and look at, if you take out the people who are just in round numbered buckets, what happens? And I wondered whether that was something that could be done here, where you have a look, and also not just to strip them out and see what's actually going on without them, but also to see if there's information in them, in the sense that behaviour has changed because of the pandemic perhaps. The shock was more broad-based, it was across a broader set of categories. Have you got more people switching between the buckets into higher categories in a way that's systematically different to the past? So that's just one set of remarks. But the second set is around the same theme, and that is the primary question we're kind of really interested in is what happens if the inflation story becomes more broad-based? What if the shocks are more broad-based than just an oil price shock? And I think it's great to use oil prices as the example. You've got a long history of oil price shocks, and you can look at what it does, and there's a clear behavioural sense that inflation expectations respond to oil price shocks in a certain way. But then I wonder how much that can be extended out to the rest of the categories in inflation, and when you get more broad-based supply-side shocks. I also, like, in that sort of frame, I have a question about the identification strategy of the VAR too, where you're effectively saying you've got an oil price shock and then people respond to it and they become more backward-looking. Are the instruments that you're using to get to the oil price shock giving you that as an exogenous effect, or is there still a bit of correlation in that story? In the sense that you're getting the shock to oil, people respond to it more backward-looking because the oil's been the shock. And I guess a third remark, which is related, is this idea that perhaps there's some information in the breadth of the inflation shock that you face. So maybe looking at how many categories have seen a rise in inflation in the current period, that the one just gone by relative to the others, gives you a different identifier. Because I think, again, that to me is the question we're looking for. What happens when you get a multitude of supply-side shocks that affect inflation more broadly?
I'm not sure. Is that 3 questions? Like,
Yeah.
I think there's one question there.
Yeah.
There's at least one response. So should we take another one?
Yeah, Renko.
Dr. Mann, thank you very much for your comments. That was fascinating. You gave quite a compelling argument against policy gradualism in this instance. One argument for policy gradualism is as a response to uncertainty. So firstly, economic uncertainty, where you don't know what the economy is doing, but secondly, model and parameter uncertainty, where you're unsure if your characterization of the economy is still relevant. So, things like the slope of the Phillips curve, so on and so forth. One policy problem that I would like to hear your thoughts on is how do you balance the arguments for activist policy, so effects on financial conditions, so on and so forth, against this other argument for gradualism, which boils down to, if you're in a dark room, you take small steps. So the question is, how do you balance those two things?
And maybe we'll grab your question.
Right? So I have a very short one. On the response of inflation expectations to oil price shocks, I was wondering how much is that driven by large oil price shocks relative to small ones? So should monetary policy really care about all supply shocks or only really the big ones, and the small ones, they will not do much in terms of inflation expectation responses?
Yeah. Okay, the last one, taking the last one first. So that local projection method addresses that question in the sense that it's both large and small in there. We could go back and redo that, taking out the small ones. So we could do that and see what happens. So it's definitely worthwhile because there is evidence that the large shocks that push you over a threshold do have much more dramatic consequences for inflation. So that doing that kind of exercise would be worthwhile as a check on what we already know from other work, that a shock that pushes overall inflation into the above 4% appears to be one that changes behavior. The first set of questions it's similar in the sense that you're asking, at least in the second and third question of the set of questions, are about the broad-based nature of the shock and whether or not we should be looking at doing something like a forward and backward-looking exercise, not that local projections, not with an oil shock in there, but say supply chain. One of the supply chain uncertainty or one of the supply chain indicators as opposed to just an oil price shock. I think there are concerns that you need to have a long enough time series in order to evaluate this. One thing that we could do is take some of the uncertainty shocks or the uncertainty indicators. Van Reenen and co-authors have done this for a number of different countries. And in the UK context, we have fairly long time series, of uncertainty shocks measured by different types of shock. Political variability, financial market variability, and macroeconomic. So stripping out and taking those and getting shocks to put into that exercise would be useful. We did do, you didn't get to see it, but we did do the exact same local projection exercise using monetary policy shocks, which is another common approach to thinking about these things. And it looks similar enough so that there's sense, and again, which large shocks or shocks that are large enough, and that was 10% in that exercise that I showed you there, does yield a change in the share of forward-looking agents, reducing the share of forward-looking agents. But it's definitely worthwhile to consider a broader set of shocks. Now, in terms of the breadth of the categories, we've done a lot of work. My team has done a lot of work looking at microdata. So it's the CPI microdata, which is the equivalent of, white bread from a 7-Eleven in Cardiff. So, the very detailed data, where we can evaluate the shares of prices that change in each time period, each month. And that has been very valuable in tracing out macroeconomic behavior for, say, goods and services. And we can decompose that even further. I'm not sure, there are two things. One is there's that work where we can get incredibly granular stuff that maps into the macroeconomic variability. But we also have our other work that evaluates inflation expectations by households against a whole variety of product categories. And only some of them matter. And it's food and it's energy. And I noted yesterday in the discussion that it was energy here, but not food. I think it was the Australia president from RBA. But in the UK, it's food and energy. And we put a whole bunch of other things in, looking for, are there other salient topics, salient purchases? Doesn't appear to be the case. So that sort of says we can, that what matters, overall inflation matters. Within overall inflation, the salient categories matter most. And so that's how we gravitate towards putting oil shocks, and we could put food shocks in, to this type of exercise. The last question you had was about the buckets. We have all the information. We could use the entire distribution. We've chosen the buckets as a strategy for presenting the information this way. I noted that if we use the whole distribution, we found that the gap between the mean and the median was increasing over time, so that effectively the group that's away from that's in the right tails has become more bulky over the last post-pandemic time period. Okay, gradualism and being in a dark room. My response to this, and because people also say, well, in the fog, don't take big steps. My comment on this, and it comes out of the endogeneity of expectations formation to monetary policy, is part of the reason why the room is dark, or part of the reason why the fog is hasn't lifted is because monetary policy hasn't taken a decisive stance. Now, gradualism also, that's the dark room, that's my response to the dark room story. But your other question had to do with economic uncertainty, model and parameter uncertainty. As inflation was rising, I was appointed in September 21, and some of the early work that came out of the staff was exactly on what monetary policy response should be when inflation is uncertain, whether it's uncertain because of the model could be wrong, or the parameters, or the forward-looking drivers. The outcome of that work made my votes early on in the inflation surge episode. I voted for much larger hikes more frequently, on the grounds that a mistake by being gradual, when in fact inflation was not going to go away, was more damaging to the anchor of inflation expectations than if you do move more aggressively. So my activist stance in the context of the rising inflation environment was very much underpinned by the research that came out from the staff that in an uncertain rising inflation environment, if you have an inflation target, you have to lean against the uncertainty. And I would argue that as we are now, we're in a decelerating, it's not double digits anymore. Inflation is decelerating. It does have this hump feature, and we're trying to ensure that the hump doesn't turn into a plateau. And that's an important ingredient in terms of the restrictiveness. I have to hold for longer, I have to hold for longer.
Right. Okay, we're going to come to this side of the room. Sharon, and then we'll go Arthur and Dom.
Thank you, Dr. Mann. That was fascinating. I just wanted to pick up a bit on the activist policy and just wondered how you think about having to respond to repeated shocks that might be pushing you in different directions. So say in 3-6 months' time, something else comes through that's actually disinflationary. The fuel price increase reverses or something along those lines. And how you think about that, and maybe the answer to that is when the information changes, you change, and you change your stance. But how you think about that in the context of communicating your reaction function, the market's understanding how your policy stance might shift, and whether or not you worry about volatility that might create, creating problems through the economy.
Yeah. Dr. Mann, thanks very much for that, Arthur Grimes. 2 points. One is that when you interpreted your impulse response functions from the oil price shock, you said inflation expectations rose, and that meant monetary policy hadn't reacted strongly enough. In public policy, we have to think about compared with what. Did the inflation targeting regime, it may have worked far, far better than any other regime possibly could have. So I think you've converted a positive statement to a normative statement, which you didn't justify. And it's also related to the issue of gradualism versus sort of a stronger response. You haven't talked about what would have happened to other outcomes if you'd have had a stronger response, either then, in terms of that situation, or now. I mean, we know, I would argue that the Reserve Bank's extremely strong response here to COVID had major effects on house prices, which shot up 50% as a result, as a consequence, and that wasn't part of the target, but there was a very huge destabilisation of the economy as a result of that, extremely strong response because it didn't take into account the effect of monetary policy on other prices, or for that matter, on other parts of the economy. And of course, we heard yesterday that one shouldn't respond too strongly to supply shocks.
Do you want Dom, back here.
Thanks very much, Dr. Mann. I was hoping to make a comment and ask a question. My comment is, thanks for the comments on the inflation target. Just one thing to add in there is, I think there's also structural reasons to target low inflation. The New Zealand and a lot of countries tax, there are distortions in the tax system that related to how we tax capital gains versus other incomes. That affects asset prices and the allocation of capital. And actually the size of that distortion is related to the average rate of inflation. And so there's an argument for keeping inflation low to minimise the importance of that distortion in the tax system. My question was pretty much the same as Arthur's, but perhaps if I could just put it in different words, that, yeah, I get that your assertion that they underreacted because they've allowed long-term inflation expectations to be perturbed. Stronger reaction would reduce that perturbance, but there would be other trade-offs in the economy. And like Arthur, I was interested in how you thought about those other trade-offs, such as the volatility of output.
Okay. Thank you for the questions, all very good ones. The repeated shocks, there are sort of two things I would say about that. One is, if I had to make a guess, I think we're going to have more positive shocks, right tail shocks, than left tail shocks. But even if you have identical tails, so your shocks are both, they are drawn from tails that look the same. One thing that we know is that there's a presence, at least in the UK, significant downward rigidity in wages and prices. And so even if you're drawing identical size shocks, positive and negative, there is an upward bias to inflation that has to be part of the monetary policy reaction function. So in order to argue somehow that there's going to be a lot of left tail shocks and they're going to be very big enough to offset this upside bias on inflation. That's a particular scenario that certainly could be run. You could definitely run that scenario and evaluate the appropriate monetary policy stance for that. I don't think that if I was choosing amongst scenarios, and we couldn't do them all, very large downside shocks to the left tail is probably not the one that I would pick as being most likely to be in evidence. But I also don't have any problem identifying. I sort of set out both in my recent lead speech, which went into a lot more detail about the domestic dynamics and conjuncture in the UK, showing the linkage between this unemployment, downward, nonlinear downward adjustment in labor demand, associated moderation, actually negative consequences for consumption, and that is a source of moderation in both wage and price setting. I've showed you just a little tidbit of data on each one of those steps. I will be able to evaluate, as I say, on a 6 to 9 month horizon, since I have 1 year ahead on all wages, I have 1 year ahead expectation for prices, and I can evaluate the extent to which both wage assessments and price assessments have been right or wrong. I have a lot of information to evaluate whether my judgments are being borne out or not. And I don't have a problem making a change in my vote under a change in economic circumstances. If I make a wrong judgment, I'll say so. I don't have a problem saying so. Sort of on the issue about compared to what, I think reason for perhaps making the assertion that the UK policymakers fortuitously, well, we're in a position of underreacting to oil prices, but still ended up at about 2%, was because of the underpinnings of the globalization, the entry of China and so forth into the global environment, putting downward pressure on global prices, which were passed through to UK inflation at that time. The other aspect that I would add about that is, whereas every other central, or a number of other central bankers were struggling with getting up to 2%, the UK was not in that group. So that gives me a little bit more of a foundation for my reading of that IRF. The two questions having to do with asset prices and coming out of COVID, I think we had a discussion about that yesterday as to whether or not asset prices should or should not be incorporated into the objective function. Our remit comes from Parliament, and they recently renewed it. Whether climate is in there or not, it kind of changes over time, but the other two elements are pretty consistent, and asset prices are not in there.
Bob, and then Andrew. And then we'll be heading into a break, so further questions from there. I'm sure Catherine's more than happy to answer them over a coffee break.
Thank you very much, Catherine. Excellent presentation. My question relates to the connections between state-dependent pricing models and what you talked about. You are really introduced here state-dependent expectations formation models and the importance of microdata. What you're able to show with regard to the proportion of forward-looking agents requires access to microdata. I've done quite a bit of research with colleagues on the same, using microdata on pricing behaviour. Really, I think this is more a comment about we are learning much more about behaviour and how the importance of thinking about state-dependent models of behaviour rather than time-dependent models of behaviour. And that was introduced in the 90s and with theoretical papers and empirical work. But we're getting more microdata about expectations behaviour. I think it was Christopher Sims introduced the idea of irrational inattention. So this is really a plug of let's make sure we invest in this sort of data. And thank you for illustrating how important that is with regard to price expectations. I have a question though, have you proceeded to try and model in the way in which menu cost type pricing models have been developed to capture state-dependent pricing behaviour? Have you done any work of your colleagues on expectations behaviour that captures threshold behaviour and expectations formation? And if so, what are the insights from that?
We're going to pick up another one? Yep.
Thank you. I have a similar question. The Reserve Bank has started monitoring the fraction of households with inflation expectations over 4%, and it's shown that while it's highly correlated with the mean expectation, that it's slightly better at forecasting future inflation than the mean. It also has the technical advantage that it better captures the expectations of sort of the crazies who are reporting 20. We know that they've got high expectations, but we don't really trust that it's 20. You're suggesting this high tail is important in England. Do you yet have evidence that the fraction of people with high expectations affects pricing decisions? Is there either direct evidence, or do you have evidence that something like the price setting hazard function is dependent on the distribution rather than just the mean of household expectations? Also, is this consistent with activist policy to help prevent price-setting cascades or avalanches when there's a large number of people with very high expectations?
Okay. So answering the question about modeling alternative dependent state versus time-dependent pricing model using the microdata, yes, there is work using our microdata to do that with the teams. There's a set of joint teams between the university. The decision maker panel is a joint product of the Bank of England and the University of Nottingham, and there are research people from both institutions, as well as some third institutions that are very busy doing a lot of work with these microdata, and one of them does evaluate the way in which we can use that information to get us, for example, to the slope of the Phillips curve and to other pricing behaviors. So yes, there's that. I made reference to research, which the speech online has a bibliography, to the research that evaluates the extent to which inflation expectations are different when inflation itself hits a threshold. And again, the 4% seems to be the threshold for when inflation actually hits that threshold. There's a change in inflation expectations as well. So that's why there's a particular salience of the forecast for the CPI to get to 3.7% in the middle of this year. So yeah, definitely paying attention to all of that. And I cannot emphasize enough the importance of looking at the distribution of responses to whatever survey you have. Means and medians are interesting, but the entire distribution is incredibly important. I was looking at the DMP data on the way up as inflation was rising, and the right tails, the weight in the right of the tail of those pricing, the 1 year ahead pricing distributions was just dramatic. Very important ingredient in my decision making at that time. So the second question about, you noted that using the buckets of inflation expectations above 4% were better at forecasting. I guess that's better at forecasting inflation. So, you know, in some sense, if inflation is going up and people think it's going up, then there is an umbrella that firms know this too, right? Firms realize that they have room to raise prices if households expect prices to be higher. And we can show that there's, again, some number of speeches ago, I can't remember exactly when it was, where, again, using the microdata, we were able to show that firms were, especially when their competitors raised prices, they raised their prices too. So there was sort of complementary price setting, which is not exactly what you were identifying, but certainly gives some support to the notion that higher inflation environments are ones that support, what goes up can go up further. Now, on the expectations side, the additional thing that I pay a lot of attention to looking at the microdata is the most income and price elastic categories of prices. So nobody needs to go to a white tablecloth restaurant. Nobody needs to buy recreational goods. Nobody really needs to go travel, except for, it's recreational travel. So it's very income and price elastic. So those are the categories that I focus on to see some evidence as to whether or not this disciplining of pricing behavior by consumers who either can't or don't want to spend money on these income and price elastic categories. And I not only look at the pricing behavior of those categories, but I have the firms in those categories, and I can also look at the stock market behavior of firms in those categories as an indication, as the leading edge of the consumer environment, quote, disciplining the pricing strategies of firms.
Okay, so we are due coffee break. I think it's back at 11:15. Please join me in thanking Dr. Mann for a presentation and taking the time to answer those. And we have a small gift for you. Thank you. Thank you.